Amazon stock has been on my list of top stocks to buy all year long in 2024, but I haven't updated my recommendation in a little while. So a lot of questions were asked in the comment section and in my email box if I still think Amazon is on my list of top stocks to buy. So I'm going to make a video here and update my recommendation of Amazon stock, let you know if I still think it's on my list of top stocks to buy or if I'm removing it here. So let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So in its latest quarter, Amazon's net sales increased by 13% to $143 billion. That was up from $127 billion in the same quarter the prior year. So an increase of $16 billion year over year in net sales. More importantly, the AWS segment net sales increased by 17%. So 17% faster than the company's overall growth rate of 13%. And keep that thought in mind. I'm going to discuss a little bit later in the video and show you why that was so important for AWS growth of 17%. Moving on, its operating income jumped, absolutely jumped to $15.3 billion in the first quarter. And that was up from $4.8 billion in the first quarter of 2023. So its operating income tripled year over year in the first quarter of 2024 versus its first quarter of 2023. Now, much of the reason for that increase is Amazon's ability to adjust to the unprecedented circumstances of the pandemic. Now, you might say, oh, the pandemic was 4 years ago. It's still adjusting, and the answer is yes, because of the magnitude of Amazon's business. In 2020 and 2021, Amazon invested something like $100 billion in its logistics and fulfillment network. And so it faced a decision during that point in time when its sales were surging as a result of stay-at-home orders. How much do we invest to make sure that we can fulfill all of this extra demand? And Amazon's management at that time, I remember reading into the conference calls, the CEO said, look, this is unprecedented. We didn't have an accurate way to measure how much to invest in capacity, but we decided that if we were going to make a mistake, we wanted to make the mistake of overinvesting rather than underinvesting, because we didn't want to sacrifice the customer experience. We didn't want to sacrifice all of these years of building up and earning that customer trust. We don't want to sacrifice that because of what's going on. So we thought we'd overinvest if we had to. If we were going to make a mistake, let's overinvest. And then we could always grow into that in future years if we did end up making a mistake, which they did. They overinvested, and you saw their profits come down significantly in 2022 and the first part of 2023. And then when growth started to increase, they really capitalized on those investments they made in 2020 and 2021 because they didn't need to add more capacity. They just grew into the existing capacity. And so that's driving these increasing profits and operating income and cash flow, as we'll see a little bit later. So they are now capitalizing on those benefits. And then on top of that, they've also optimized the position of the network, the positioning of the inventory. So instead of having inventory in centralized locations, they've sort of decentralized and gotten inventory closer to major customer hubs, closer to big cities like New York and Los Angeles and Chicago, to make sure that they have inventory closer to those locations. So when orders come in from those locations, the packages don't have to travel as far. And if the packages travel in shorter distance, that's less cost to serve, and that's faster time to ship, both of which is great for Amazon's business, both in terms of the customer experience and profitability. And so they've really, really benefited from that, and they've done a great job in benefiting from that and optimizing their fulfillment network. And that's really driving profitability for the company here in 2024. I highlighted the profit numbers. Now let's take a look at the excellent cash flow numbers. Operating cash flow increased by 82% to $99 billion. That was up from $54 billion for the trailing 12 months of 2023. $99 billion in operating cash flow this business generated. Free cash flow was $50 billion compared to negative $3.3 billion in the previous trailing 12-month period. The difference between operating cash flow and free cash flow are capital expenditures. So free cash flow equals operating cash flow minus capital expenditure. And so that's the difference you see there. They still invested in the growth of the business while generating $50 billion in free cash flow. So really benefiting from the build out of that logistic network. And that's one of its primary competitive advantages. Very few companies would be willing to and have the capability to build out a fulfillment and logistics network the size of Amazon's, with the reach of Amazon's, in not just domestically in the US, but internationally as well. So they continue to delight customers with fast and convenient deliveries, more than 2 billion global units arriving same day or next day in Q1, and Amazon delivered to Prime members at its fastest speeds ever. The faster speeds you promise, the more it's going to induce sales. When customers go onto the Amazon website or the app to buy something and they notice that they can get the product in the next day or in the next 2 days, it makes them more willing to purchase compared to if there is no delivery promise or if the delivery promise is like over the next 7 days. So looking ahead for the second quarter, they're forecasting 9% growth at the midpoint. And given the data that's come out since Amazon has made this recommendation, I feel the net sales growth is going to trend closer to the higher end of this guidance. One of the main reasons for that is consumers have pretty much completed their unleashing of demand for away-from-home experiences. I've been talking about that trend for a couple of years now. Ever since the economic reopening started, consumers have been unleashing this pent-up demand to get out of the house, to spend money away from home. Restaurants, bars, theme parks, concerts, ball games, travel, etc. Right? But in the last few months, I've noticed a slowdown of that trend, a reversal of that trend. So it's peaked. Now consumers are looking at away from home experiences, looking at the prices, looking at the crowds and saying, you know what, maybe we'll stay at home instead. Right? Prices have increased meaningfully across all those categories I highlighted. And consumers no longer have those robust balance sheets with the stimulus money from governments any longer. So now they're saying, okay, we did our away from home thing, and that they're now retrenching. At least that's what I've seen in the last couple of months. And so that's good news for Amazon because that means more shopping at home. Operating income expected to jump to $12 billion, up from $7.7 billion in the second quarter of the prior year. And so if the sales come in higher than expected, operating income will also likely come in higher than expected. Okay, so now let me share with you why that 17% growth was so important for Amazon's AWS segment. I've highlighted here Amazon's net sales growth for the AWS segment. And you notice here that they had a poor streak going where the growth rate was decelerating. 12%, 16%, 12% again, and 12% again. And so investors were wondering, is this the end? Is this going to continue decelerating? Is competition eating up AWS growth opportunities? And then Amazon turned things around from 12 to 13% growth, and from 13 it jumped to 17% growth. And that's giving investors confidence that Amazon's AWS segment is the leader in the cloud segment, but now it's regaining, reaccelerating revenue growth. And that's coming with higher profit margins. You notice the profit margin here in the AWS from 24 down to 20, still 24, and then it jumped to 30, 29.6, and now 37.6%, the highest ever operating profit margin in this segment. And if you compare that to the rest of the business, you look at the operating profit margin for the North America segment, just 5.8%, and in the international segment, just 2.8%. So AWS is roughly 10 times more profitable than the other parts of the business. And so that's why it's so important that AWS is reaccelerating revenue growth. And all this while Amazon stock price has increased already in 2024 up to $182 per share, but it's still trading at a relatively cheap valuation at a forward PE of 31.9. So given its excellent prospects and the still relatively cheap PE, I'm going to reiterate my recommendation and highlight that I still think Amazon stock is a top stock to buy for 2024. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.